Alrighty, everybody. Very excited to go kind of as a mortgage 101 slash what should we as an agent know in terms of lending purposes. Now, caveat to this is not a class on how to become a lender. So do not think that you're going to walk away here knowing how to qualify people down to the dollar and all that stuff. This is, as an agent, what should we know to at least inform our clients and continue the conversation in a way that's beneficial to them, as well as helping us establish credibility. Because one of the best ways to establish credibility as an agent, as a professional, is knowing how to run numbers for people. Because whenever we're talking financing, for a lot of people, it is beyond the scope of their thought process. So it's a great way to help build credibility for there. Also, another caveat, this is mainly for residential owner-occupied qualifying purposes. We're not going to sit here and talk about as people are doing investment properties and doing this and all the tricky stuff that you can do with, creating LLCs and S corps and doing all this crazy stuff. These are people who want to buy principal residence, owner occupied. These people are coming to us saying, hey, it's going to be our first home. We don't even know if we qualify, all of those types of things. So additional caveat, last one before we get started, is be careful when you're qualifying people. Just know that we are salespeople. We are real estate agents, not lenders. So be careful whenever we are talking to people about qualifying purposes. Never assert you will qualify for X, Y, or Z. It's always talking to them about the potential and asserting to them that they need to speak with Raj. They need to speak with your lender to make sure that they verify that information that you're talking about. Because again, we are the salespeople. We're here to take the number from Raj and then see what can we get them into as that's concerned. So again, last caveat would be for that. So us as agents, when we talk about qualifying for agents, the number one thing above finances that I care about as an agent is qualifying them based upon their motivation. So this is the only thing that I will talk about that's not really numbers related, that before you even get into the numbers with people, you really as an agent want to qualify them based upon their motivation, because that, even more than their financial ability to purchase a home, we're really going to lean on, do they really want to buy a home? Do they need to, in their mind, purchase this home? Because there are 1,000 reasons not to buy a home, on top of them being able to qualify. So one of the first things before I get into qualifying a potential buyer is I chat with them about their true motivation. Like, what are they looking to accomplish with this move? Talking about where their current living situation is. Are they renting? Do they own already? They're going to sell and buy. But if it's their first time buying, especially chatting with them about their current living situation, on how long they've been renting. Are they currently in an apartment? Are they in a condo, a townhome, a single family residence? How long they've been renting, seeing if this is an undesirable situation for them, the stick that's poking them to get out, or maybe they've been living there for 15, 20 years with an artificially lowered rent, and it's going to be sticker shock when they finally find out what they can purchase. So then it's easier for them to sit back into their laurels of what they've always continued to do. So the first thing is always about the motivation. How important is it for them to purchase? And then moving into the actual numbers. Now, when it comes to loans, there are different types of loans, but the primary two that we're really going to be dealing with as agents are going to be government loans and non-government loans, is the easiest way I can think of signifying the two. Government loans are really structured into two main ones. There are other ones, but really two main ones. Number one, VA, which in my opinion, the most incredible loan program that is ever created. I don't think we've done enough for our vets, but this is one awesome thing. And the second one, FHA, or the Federal Housing Administration. The main difference between those two that I personally always think about is there is no mortgage insurance associated with VA loans. Rule of thumb, anytime a client is putting less than 20% down on a loan, there will be mortgage insurance associated with that loan to ensure the lender, if you default on that loan, that they are recouped. That is not associated on VA loans. There is an additional what's called funding fee that's associated on that, but that's a whole different topic that we can take if we do a deep dive into VA loans, which we'll do on a later training class. But FHA and VA loans are government loans. And non-government loans, the most common that we're going to talk about is conventional. Conventional, whenever you think conventional loan, think normal loan. That is a pretty traditional type of loan. And there is what you'll also sometimes hear is conforming. And then sometimes you'll hear non-conforming loans. Now, conforming just means that it's a conventional loan that can be sold to Fannie and Freddie on what's called the secondary market. So not only is it fitting in the box of conventional loan from that particular lender, but it also has to fit the guidelines of Fannie and Freddie, the two largest banks on the secondary market. Now, why would a client choose one over the other? That's a big question that we get. Why would I choose conventional versus FHA or FHA versus conventional? Now, if you have a vet, 99 times out of 100, the best option for them is going to be VA, primarily because they can put less amount of money down. They can actually do 0% down for VA and have no mortgage insurance on that. Also, what we're seeing very commonly is that VA rates are going to be lower than conventional rates. Not all the time. Check with your whatever the time you're watching this video, but the majority of the time, especially that we're seeing right now, VA rates are lower than conventional rates. Also, they will have higher debt to income ratio allowances. So there's actually 3 things that a lender looks at when they're looking to qualify you. Number 1, your credit score, right? We all know that they're going to have to run your credit. That is how risky of a person the borrower is, meaning checking in the past to see what has been your history of paying back loans will gauge how risky that person is, because they want to think, will we get paid back based upon the history of that borrower? The second thing that they look at is the ability of a borrower to pay that money back, which they use as your debt to income ratio. Do you have money coming in every month that can cover the debts and that monthly payment, which they call debt to income, or what lenders will call DTIs, right? Every industry has vernacular that makes you feel like an outsider. You'll hear DTI, that means debt to income ratio. So that's the comparison of the monthly payment compared to your gross income that you have. Most commonly, they will use what they call back-end debt to income ratio, which means the housing payment, PITI, which is principal, interest, taxes, insurance. Also, they will add on any mortgage insurance or any housing HOA amount, which they will just add in, combined with any additional debts, right? Like car payment, student loans, jet ski payments, anything that pops up on a credit report, they will add to the housing payment, which they call your back end ratio. And primarily conventional will have a lower allowable debt to income ratio than the government loans. As of right now, as of recording, I spoke with Raj right before I hit record. He said, as of right now, rule of thumb, right? Because there's always mitigating circumstances, right? But rule of thumb, 45% back end debt to income ratio for conventional, and about 55% back-end debt ratio for FHA. Now, VA, there may be more flexibility based upon mitigating circumstances, because again, VA is the greatest loan program in the history of loan programs. So if you have VA borrowers, oh my goodness, get them connected with Raj, get them connected with the lender, because it is an awesome situation. Primarily FHA and VA, you can have lower money down. So FHA can actually go down to 3.5% down. For FHA, that's one of the more common ones, but you can have a 5% down FHA. You can have a 10% down FHA. Same thing with VA. You can have a 5% down VA, 10% VA, whatever you want, but it goes down to as low as 0% for VA and as low as 3.5% for FHA. Now, you may hear about additional programs like what we have going on right now, which is Gsfa, which is the Golden State Financing Authority, which is actually considered what's called a second loan on the property. That is a down payment assistance where you can actually have additional loans that will help offset that 3.5% down. But for the sake of discussion right now, 3.5% down FHA is the lowest you can have, pending any down payment assistance program, with a debt to income ratio of 55%. Conventional, there's actually some conventional programs that could be down to 3%, but there have to be some mitigating circumstances for that. More commonly, we will have 5% down conventional, but there are additional ones available. Check with Raj for your specific income ratio. You also get to have lower down payment. Why would anybody want FHA, or why would anybody not do FHA? Generally, it is because the mortgage insurance, remember, anytime you have less than 20% down, you're going to have what's called mortgage insurance. Mortgage insurance is more expensive for FHA. And as of, I believe, 2016 or maybe 14, I don't remember the exact year, they actually made it that the mortgage insurance remains on that loan for the lifetime of that loan, AKA forever, or until you refi out of it. Whereas conventional, if you put less than 20% down, once you get to at least 20% equity, the mortgage insurance falls off. You just have to make a phone call and ensure that it is a 20% equity. It doesn't just automatically. You have to call them and just say, hey, I think it's that 20% equity, and it actually falls off of the loan. However, for FHA, it remains for the lifetime of the loan. That's one big difference. So the mortgage insurance is more expensive, and it remains forever or until you refi. So that is one big difference. Also, conventional, once you put more money down, it is generally the cheaper option. So if you're going to be doing a standard loan of 20% down and all that, you're primarily going to be doing conventional. And if you're going to be doing less than that, more common than not, if you're working with first-time home buyers who don't have that much money, or they have shakier credit. Oh, that was the other thing. If you have lower credit scores, FHA or VA will usually be your best bet, because VA and FHA, as a rule of thumb, will be able to lend on lower FICO score than conventional. So if you have clients with lower money to put down, they have less of a down payment, they have shakier credit, FHA or government loans would be your best option. If you have clients who have awesome credit, they have plenty of money, right? At least 20% down, or sometimes even 5-10% down. If they have better credit, they'll usually get a better rate and better terms on a conventional loan. So there are, when we talk about approvals, it's often a misconception about what is an approval or pre-approval, pre-qualification, and all that. The way that I look at the approval process, I look at the approval process as being a function of the verbal pre-approval, or sorry, the verbal, the visual, and the verified. That's how I simplify it. The verbal, the visual, and the verified. The verbal means a 5-10 minute conversation on the phone with the lender. You give, Raj talks to them for 10 minutes and they're like, yeah, make this is how much money I owe, this is that. He said, well, based upon that, we could pre-qual you for about this amount of money. That's a pre-qual. I just think of phone call, okay? Pre-qualification. So whenever you have a client come up and said, oh yeah, I've been pre-qualled by my guy, right? Everyone's got a guy, right? My lender pre-qualified me for 500,000. That's usually just a phone call. The second step is the visual, meaning they've actually seen documentation, which constitutes a pre-approval. That means that they've pulled credit. That means that they've seen their tax returns, they've seen their bank statements, they've seen their pay stubs, right? Generally, rule of thumb, I always like to say twos, meaning 2 years of tax returns, 2 years of W-2s, if they have it. It's either the full 1040s or W-2s. They're 2 months of bank statements for whatever bank that they're using for the down payment and closing costs, and the 2 most recent pay stubs. I just like to keep things simple, right? I just think twos, 2 years, 2 months, 2 periods of pay periods for that, and running the credit to get a pre-approval. Then the next step is actually an in-between step between the visual and the verified, which depending on the loan program they're using, it'll either be called DU approval, or sometimes they'll call it LP. More commonly, you will hear DU. You may see that in even the private remarks of a listing. It may say, submit all offers with proof of funds and DU. Common question I get. That stands for desktop underwriter approval. So not only have they seen the tax returns and all that fun stuff, but they've submitted it to an automated desktop underwriter that runs all the numbers and plugs back on either an approval or not approval on does it fit with Fannie or Freddie's, or depending on if it's DU or LP, will say, yes, it fits their criteria. And it'll usually be like a 6-page DU findings you'll see. That's kind of a half step in between the visual and the verified. You'll see it's DU approval. The verified, some lenders will call that subject to financing. Some lenders will call that manual underwriter approval. Some lenders will call that TBD financing, depending on who you talk to. What that will generally mean is that they went through the formal process of verifying all the information, where they actually go to the IRS and they pull the tax returns from the IRS to make sure the copy that they were given by the borrower match what the IRS was given, to make sure there's no fraud or anything crazy like that. They also go through and get what's called the verification of employment from their work, where the work says, yes, they're still employed, not just 2 months ago when you got that the pay stubs and all that, where they go through and they formally verify everything. Now, depending on the workload of the lender will determine how long that process will take. Generally anywhere between 2 to 3 weeks, but subject to the workload of the lender at that point in time. Being that we are in a refinance boom right now, it may take a little bit longer. Chat with your lender at that specific time. So those are the four options, right? The pre-qual on the phone, 10-minute conversation. Pre-approval, visual, they've seen the documentation from the client, which again, 2 years of tax returns / W-2, 2 months of bank statements from wherever the money's coming from, the 2 most recent pay periods, and of course, running credit, right? The half step, number 3, DU approval, formal, a desktop underwriter approval. It's an automated program that spits out if it's approved or not based upon Fannie Mae's, based upon those specific ones, meaning does it fit their box? And then number 3 is the verified, AKA manual underwriting process, where they go and verify everything, where they basically say you are approved for the loan subject to a clean title and an at value appraisal. That's basically as close to cash as we could get when we have a loan. If you have buyers and they are not necessarily writing offers right then, but they're getting ready to do that, this is the best option for them, because they will have the strongest level of pre-approval. And that's also, you're able to shorten and tighten up your time contingencies, which if you think, which is a different class of how to get your offer accepted, the seller really cares about two things if we want to boil it all down to an offer. It's 10 pages, but it's really two things. Number one, how much money am I getting? Obviously, right? And number two, how likely am I to get that money? Those are really, at the end of the day, what a seller is concerned about. How much money I'm getting and how likely am I going to get it? I just call it greed and peace of mind. So if you're able to get the number one thing that's concerning for a seller, which is can the buyer get the loan or will the buyer get the loan? If you get that handled by talking to Raj up front, you're going to have the easiest time getting your offer accepted as well as the best deal for your client. Now, when we talk about the qualification process, we already mentioned what documents they're going to have to supply. That was a gross simplification, but that is the most important, which are the 2 years of tax returns, right? /1040s /W2s, depending on, sometimes they want both, right? Even if they are W2 employee. Number two, they're going to want that 2 months of bank statements from wherever the money's coming from. And number three, your 2 most recent pay periods of your pay stubs, and then your credit. And then they're going to also want, you know, a copy of your driver's license and all that fun stuff. And they're going to verify everything. Just expect letters of explanation for everything, but that's enough to get the ball rolling. So that's how that rolls. Now, one of the questions I have received was initial deposit versus down payment versus closing costs. Now, when you initially write an offer, there will be what's called the initial deposit, which per the contract, within 3 business days of your offer getting accepted, the buyer will need to bring in an initial deposit. Most commonly, it's with a wire transfer or an electronic funds transfer, but sometimes you'll hear cashier's check or personal check. Don't advise those. I personally don't. I'm a huge fan of wiring, especially now during a pandemic where everything's difficult and oh my goodness, right? So that's the easiest way to go about it. But the initial deposit, a full deposit, is considered 3% of the purchase price, right? You don't have to, it's not mandated, but that is what's considered a full deposit or a standard deposit. That amount, let's just say for the sake of discussion, is 3% of the purchase price. That 3% or whatever that number is credited towards the full amount of the down payment that the buyer needs to eventually bring in. So let's say that they're doing a 3.5% down FHA loan. If they bring in 3% within the first 3 business days, at the end of escrow, which is when the remaining funds with the down payment need to come in, they only need to come in with 0.5%, 0.5%. Same thing if they're doing a 20% down. They bring in 3, they only have to bring in the rest of the 17, if that makes sense. Now, there is additionally for every loan, and even ones that are all cash, there will always be closing costs. Now, depending upon the loan and depending upon the time of year will determine how much closing costs will be required. If there's no loan, let's just say it's an all cash deal, I still, rule of thumb, like to account for 1% of the purchase price for closing costs. That goes towards their amount of the escrow, the title, all that fun stuff. If there's a loan involved, anywhere between a total of 2 to 3% of the purchase price, rule of thumb, depending upon the time of year and depending upon the loan. When I say depending upon the time of year, there is something called impounds, which that's a whole different topic and a whole different class. Just know that that gets added to the closing costs, and that will dictate whether they're closer to the 2 or closer to the 3%. So it's just something to keep in mind. Anything, it would be, that's in addition to the 3.5%. So anywhere between 5.5% to 6.5% if they're doing an FHA, and so on and so forth. Special little trick. If rates are like they are as I'm currently recording this video, extremely low, There is something you can do if you have a client who is short on funds. You can do a couple of things. Number one, if the market is softer or if there's less interest on that house, you can actually ask for the seller to assist with down payment closing costs. Meaning you can write an offer, let's just say for the sake of discussion, for $500,000 and ask the seller to pay for X dollar amount toward the buyer's closing costs. When the market is extremely hot and there's multiple offers, the likelihood of that offer getting accepted is very low because you're asking the seller, in a sense, to take from their proceeds to help your buyer pay for their loan. Sellers don't generally want to do that. So a common way that some agents have done this in the past is what's called building that into the purchase price. Instead of writing the offer for $500,000, they may write the offer for $505,000 and asking the seller to pay $5,000 towards the buyer's closing costs. Challenge with that is if you're already running up against an appraisal issue, meaning you're at the higher end of the valuation range, that may concern the seller of, well, we're already pushing value and we're trying to push it more so that way I can pay for your closing costs. Long story short is the seller, in the seller's mind, just looks at it as a cost negative, meaning if you offered 505 but are asking for 5,000 in closing costs, it's really as if you're offering 500,000. So if that's not an option, you can do another option, which is called bumping the rate. We may hear on advertisements, or you may have heard that you can buy points down, meaning you pay upfront money to get a lower interest rate. Very common for us to hear. You may hear like on radio ads, a 2.5% interest rate at 2 points. They'll usually just say at something points. That means to pay a percentage point of the loan to get a lower interest rate. As an example, if you're getting a loan for $500,000, and if you have to pay 1 point to get a certain interest rate, that means you have to bring in 1% of that loan amount, which is $500,000, aka $5,000. That's called 1 point. It just means 1 percentage point of the loan amount. Conversely, if you have less money to put down, you can bump the interest rate. So instead of getting a 3% interest rate, you can bump it to 3.5% and get closing cost credit, if that makes sense. Chat with the lender at that point in time to find out what that amount is, because it changes on a minute by minute hourly basis. So I can't say on average it's X to Y. It depends upon the cost of the loan at that time. But that's a great option sometimes to do both, meaning ask the seller to give you a credit towards the closing costs, bumping the rate to be able to get you more closing cost coverage. And that's a great way to limit the amount of down payment or the amount of total what is called cash to close, because that I just skipped forward a little bit, which is the down payment plus the closing cost is what's called total cash to close. You will see that on the lender sheet. They'll say total cash to close. That's the combination of closing costs and down payment. That's a question that we have gotten a number of times. So I know that was a lot of fun stuff for that, but hopefully that at least shed some light on the basics. Also wanted to share with you guys in terms of FICO scores and all of that. Now, those, as far as what you're able to qualify for with what payment, depends upon the loan and it depends upon market conditions. Because up until this wonderful pandemic, we were able to have lower FICO scores and able to still qualify for loans. But as soon as there are any market shifts or whatever, FICO score requirements are usually the first things to tighten up because they want to lessen the amount of risk. Conversely, the stronger the market, the more they will lessen those requirements. So as of right now, the lowest that I'm aware of for FHA is 580 for a FICO score. Just know that FICO stands for, I think it's Fair Isaacs Corporation. I think it's something like that. Whatever that is, it's something like that. It's FICO scores. It's a combination of three metrics. It's Experian, TransUnion, and I'm blanking on the second one.
Equifax.
Raj, what's the third? Equifax. Thank you, sir. Equifax for the third one. And they'll usually go by the middle of those numbers. So a client may oftentimes come to us and say, hey, my credit is bad and I don't think I can qualify for a loan. Usually sites like, Credit Karma or any of those consumer sites will only pull one of those numbers. So just know that that could be the low end. Also know that could be the high end. So a lender will actually look at a different FICO score than what they're able to see on consumer sites. That's number one. Whenever you have a client who says they have low credit or they don't think that they have high enough credit, or they'll disguise it as different things. Number one, you will see, or a lender will see, a different credit score than they see. We have seen them off by at least 50 points from time to time. So you'd be surprised, Mr. and Mrs. Buyer, that a lender sees a different credit score, and we've seen them off by a significant portion of the time, as much as 50. I've personally seen them off by 80 points before. Because sometimes that you pay off, a very common one is like a student loan or medical collection or something that they paid it off or it got discharged or what have you, and it got reported to all these other bureaus except for the one that's being pulled, and that score is drastically lower than the other ones where that shows paid off or what have you. So it's something to keep in mind that it's a different score. It can be off by a significant amount. And when you get with Raj, and if they pull your credit and we find out that it is too low, we can put you into our credit enhancement team. Raj has an entire department that is completely devoted to helping clients improve their credit score, where they will give you a menu of potential score improvement with little tasks, little suggestions. Pay off this card, do this, do that. Sometimes we don't even sometimes it's not even recommended to pay off cards. I've actually seen times when they've actually recommended to buy things on the card to establish credit history. Sometimes it's opening additional credit lines. Every case is a little bit different depending on clients. So it's a different score. It can be off by a significant amount. And if it is still too low, we can give you a menu of items and about how long it could take. So it's something to keep in mind that no matter the client situation, we can help them. Credit scores, as an idea, is anywhere between 300 and 850. 850 is being perfect credit. Personally, never seen 850. I've seen pretty close. I've seen 830 is the highest I've personally seen. But 850 is perfect. Average is about 700 is considered average credit. Top tier credit, depending upon the time of year and the loan program, is anywhere between 740 to 760 is considered a top tier, where you're getting basically the top amount. Every 20 points, rule of thumb, you're going to be in a different price category. So if they're on that verge between, they're at 695, and if they go from 695 to 701, they're generally going to be in a different tier and get a better interest rate. So FICO score was number one, can they get the loan? But also, how expensive will that loan be? So that's generally when clients say, I need to improve my credit. They're like, hey, my credit was only this, where they could get the loan, but it's costly. And sometimes it is a significant difference. Talk to Raj to find out where those thresholds are at that time. Rule of thumb, the better the FICO score, the better the interest rate, or I guess the lower the interest rate, but the better it would be. Good rule of thumb. I'm a fan of rule of thumbs, right? Also, when it comes to calculating payments is a big question we have. Short answer is be careful with this. Be careful with this. Be careful with this. Raj can tell you, be careful with this, because they will start making mental preparations based upon any number you give them, whether it's accurate or inaccurate. However, math is math. So wherever you get it from, it's going to be a correct number based upon the input you put in. The biggest variable factor is going to be the interest rate. Let me tell you how big of a factor interest rates are. If you modify the loan amount or purchase price or whatever, it's the same amount, right? Or not same amount, but the same influence. If you modify the purchase price by 1% or the loan amount by 1%, their monthly payment will adjust by 1%. Meaning if housing prices go up 10%, or their loan amount goes up 10%, their monthly payment will go up 10%. Make sense? 1-to-1 ratio. However, interest rates are a 12-to-1 ratio, meaning if interest rates go up 1%, meaning as of right now, it's like 2.75%, freaking insane, astronomically low. Astronomically low? Who uses that phrase? It's usually astronomically high. Asininely low, right? If they go from 2.75 to 3.75, monthly payments will go up 10% or 12%. Sorry, it's a 12-to-1 ratio. Insane. About, right? It's not exactly 12. It's like, depending upon the interest rate, it's 11.5 to 12.5, right? But it's a good rule of thumb. So something to keep in mind, that because you're inputting your interest rate because of what they tell you, you're off by 0.5% because maybe their FICO score is lower than you were expecting. That will influence it by a lot. But just know that wherever you go to, the math is math. I don't care. I don't trust Zillow for anything, but they actually have a good mortgage calculator. And I say good because it's pretty. It looks nice. It has a nice little bar, or it's like a pie chart, right? And it says what percentage goes to this, what percentage goes to that, right? But rule of thumb, which I'm a big fan of, right? Rule of thumb is for every $100,000 of loan, it changes their monthly payment by about $500 a month. Now that's calculated at slightly over 4% of an interest rate, which sounds insanely high. But when I first got started in the business, they were like 4.5%, and then they steadily dropped, and it was crazy, right? Traditionally, just as an FYI, in 1981, interest rates were at 18.6%, the average. If you had bad credit, it was higher than that. I've personally heard of people getting over 20% as an interest rate before, but in 1981, they were 18.6% national 30-year fixed rate mortgage. The lowest they were before the wonderful COVID-19 pandemic was 3.31% in 2012. We are now below that, to the lowest ever in 5,000 years of history, right? Insane, right? So we are below where they've ever been, but also significantly less than where they've ever been. A good benchmark is somewhere around 6%, was like kind of average, if you will. So anything really below 6% is a good interest rate, or really anything, it's crazy. But anyway, about $500 per 100,000 in purchase price, dialed down about $50 per month for every $10,000 in purchase price. Meaning, if you're negotiating, here's a secret on dealing with buyers on counter offers specifically. Counter offers specifically is don't talk to them in terms of overall price, meaning they're countering you at $10,000, because that's not really what they're countering them, because most buyers are buying monthly payment, most. So whenever they're countering, if it's a $10,000 counter, that's $50 a month difference. Is this house worth an extra $50 a month to you? And also down payment, right? If they're doing 20% down, it's an extra $2,000 down and $50 a month, right? If it's 3.5% down, it's like infinitesimally small, right? So whenever you're talking counter offers, think down payment, monthly payment, because that's generally what buyers are buying. Something to keep in mind. To a seller, it's 10 grand right now. To a buyer, at 3.5% down, whatever that is, was that $350? $350 and $50 a month, right? It's going to be closer for conventional, about $40 a month right now, or $400 every 100,000. For FHA, it's going to be closer to that $500 for every 100,000, or $50 for every 100,000, or for every 10,000. Rule of thumb for calculating when you factor in property taxes, commonly forgotten about, because there's 4 things that make up a payment: principal, interest, so we combine that to 1, right? Taxes is property taxes. Easiest way to estimate, rule of thumb, property taxes, take the last 3 zeros off of the purchase price. Meaning if it's a $500,000 house, it's about $500 a month. That's with a 1.2% property tax base. Our area, generally around 1.1 to 1.2%. If you're dealing with homes that were built, again, rule of thumb, around 2000 or after, you're going to be more often than not dealing with Mello-Roos. Mello-Roos, determined upon that specific situation, but brand new construction, for example, you're dealing with new construction, very common to see 2% plus for property taxes. So keep that in mind. A great website to go to, my favorite, I'll actually screen share that really quick with you guys. Hold on one second. Let me screen share this really quickly. mello.ocgov.com. mello.ocgov.com. I'll share with you why I love this website. This only works in Orange County. Other counties may have their own version of this, but I've only found this in Orange County. Let me share with you guys, if you guys want to know my personal home, feel free to write me some awesome letters, right? 15 Chandler Place in Rancho Santa Margarita. So when you do this, you will hit start tour. Oh, geez. Oh, whoops. Sorry. You'll actually hit search, which your wonderful faces were blocking this. You just hit search and it will pull up. Jesus. It will pull up all the surrounding properties. So if you don't know the property address, just search a property and just try to find it. But go to view details and it will actually share with you what the total tax rate is for the property. If you want further information, which is freaking incredible how they can do this, there's actually a link that takes you directly to the actual property tax bill, which is pretty darn cool. A little bit Big Brother and creepy, but pretty darn cool. The reason why I like this, I'll share with you why, is if this is in an area that you're regularly working, what's really neat about this is it gives you the phone number that is associated on the different items. Like if you want to know about the Mello-Roos, like here's one for Capistrano Unified with a phone number. you can contact them and ask them, hey, what's happening with this property, with this Melrose? When is it set to expire? That way you can have some inside information. But that's a great website for getting exact numbers. But rule of thumb, 1.2%, just lop those last 3 zeros off. For single family homes, the last ones are going to be taxes and then Melrose. Sorry, taxes and HOA, right? So, insurance and HOA are the last two, because it's property tax, it's principal, interest, taxes, insurance. But the first two, principal and interest, that's that estimated $500 per 100,000. And then property taxes, take off the last 3 zeros, add it in. And then insurance for a condo, about $50 a month for a condo. It's what's called walls in insurance, usually about $50 a month. For a single family home, right? For a single family home where you're insuring the building, anywhere between $100 to $150 a month, good rule of thumb. If it's in a fire zone or it's in a flood zone or something like that, it could be a little bit more, like $200 a month. But I usually like to do $100 or $150 to be safe if I'm estimating, right? So that's a good rule of thumb for calculating monthly payment on the fly. Just calculate how many how many versions of 500 a month are there. Add in the property taxes by taking off the last 3 zeros. Is it a single family home? $100 to $150 a month. If it's a condo, $50 a month for insurance, and then whatever the HOA is. That's a good way of loose leafing it. Sound good? Now, if we want to get complicated, I personally have a spreadsheet that I love that makes it easy for me to calculate rent versus buy. Because here are the 3 concerns you will get from a buyer who's renting. If it's a first-time buyer, you will usually hear 3 things. Number 1, credit. That's one of the big ones, right? Most people have less than stellar credit. The great news is we have a solution for that. You get together with Raj, we can check it out and give you, if it is too low, we can give you a line item list of things to do to improve it. But at least you'll know, right? The second thing is down payment. The good news is FHA can go down for 3.5%. And there are regularly first-time home buyer / down payment assistance programs available. Again, this is in regards to primary residence, aka owner-occupied property, right? I'm not talking investment property where they want to buy, they're buying whatever. This can actually work up to a 4-unit. A fourplex, one of which they're intending to occupy. So if you have clients who are looking for investment property, ask them, are you planning on living in one of the units? Because FHA and VA, they can buy up to a fourplex if they're going to live in one for no money down with VA. Insane. With no mortgage insurance. And have the other 3 people renting offset their payment. Awesome. Also, you can actually use the rental income from those to potentially offset your qualifying. That's a different topic, right? But again, that's a great option for us. But when it comes to rent versus buy, sorry, it was the FICO score, the down payment, of which there are always options for people. Check at this specific time, okay? And then also number 3 is their ability to qualify, right? Is the payment, because their ability to qualify is based upon their payment. So I will share with you guys really quickly the spreadsheet that I've used, because usually what people will do, what renters will do in their head is compare what they're paying in monthly rent to what they will potentially pay in monthly housing payment. Now, when you're doing that, you have to be careful. There's a lot of asterisks on this spreadsheet that I'm going to share with you, but I want to share it to you to just get you kind of thinking. But whenever you're talking about payment, you have to compare apples to apples, because housing payment is very different from rental payment, meaning a portion of your housing payment every single month is going towards paying down your total loan balance, or what I like to call a forced savings plan. That's the way I position what lenders will call your debt pay down. Lenders will say, well, your debt pay down factor will be X% or whatever. I just call it a forced savings plan. So a portion of your monthly payment is a forced savings plan. Conversely, portions of your monthly mortgage payment are what are called a tax write-off. So you actually get a tax advantage for making your payment every month. What are tax deductible? Asterisk, asterisk, it changes. So check your current tax codes. But in generality, property interest or mortgage interest is a deduction. The good news is the most of your payment that will ever go to interest is right in the beginning. So you get the most benefit when you need it the most, which usually first-time home buyers will be purchasing their home as they're accelerating in their careers. Usually, rule of thumb, we don't know, but usually they're usually on the upward trajectory. That's also when they need it the most, you get the most amount of benefit. What else is a tax write-off? Property taxes can be utilized as a tax write-off. Now, depending upon the year, I have heard that your mortgage insurance can be a tax write-off. Check with your CPA, right? But there are other things that you can additionally do, like if a portion of it is your home office or anything like that. However, the most common are going to be your mortgage interest and your property taxes. So at the end of the day, only a percentage of your monthly payment will be what's called a net effect payment. One thing as a buyer or a borrower, as the lenders will call them, what you can do, because they may say, well, that's fine, that's at the end of the year. A common thing that not a lot of agents are aware of, but if you've ever purchased a home, you know that when you have a W-2 employment, you have what are called your dependents or your deductions or what have you. You check with your HR rep. You can raise your level of dependence, which means that they withhold less of your pay stubs or whatever, your payments or your wages. They withhold less of your wages in your paycheck, so you can get more money every pay period that can be offset by the tax withholdings or the tax benefits you receive. Confirm with your CPA, check with your HR rep, but that's a way to help merge those two, where you'll get less of a refund at the end of the year or every April, but also you'll get more of a write-off so they can offset them. Something to keep in mind. So let's chat really quick about the spreadsheet, and I will make this available to you guys. Now, be aware, this is the way my brain thinks, so it might be a little bit weird. I actually, for this training class, tried to simplify it to share with you guys. So I will do a quick screen share. As an example, okay, this has multiple sheets to it because my brain is very crazy and it goes all over the place. This one sheet I just called my summary sheet to give you an example and to share with you. This is where all the calculations are done, and I'll even zoom out so you can see what I'm talking about. Crazy calculations, additional crazy calculations, additional crazy calculations, additional crazy calculations, crazy calculation, crazy calculation, crazy calculations. Everything is here on the summary sheet. Let's use this as an example, okay? If you have a buyer who wants to buy a house for $500,000 and they want to put 25% down, or sorry, not 25, sorry, $25,000 down, and they're going to get an interest rate of 2.75%. We're using as an example. Their monthly principal and interest payment would be $1,939.15. Their monthly payment, PITI asterisk, what I used was a 1.1% property tax rate. And I also used $50 a month for insurance and $300 a month for HOA. So if you want to adjust it, it's on what is labeled the info sheet. But because I didn't want to make this summary page insanely huge, I summarized it with just here. So their PITI payment would be $3,083.94. Now, very common for a buyer to squeal at that and say, absolutely not. I do not want to pay $3,000 a month. Where you can actually share with them at these criteria here, $850.60 every month will actually be going towards their principal, which is 44% of their principal and interest and 28% of their total PITI payment. Additionally, of tax savings asterisk, based upon a 22% tax bracket, federal income tax bracket, which by the way, based upon 2019 tax brackets and rates, that is somebody making between $52,000 and $79,000 per year. You can adjust this. If they're higher, you can adjust this to 24 and what have you. But again, summary, trying to summarize it, would be $411.96 of savings every month, which would be an actual net payment if you subtract the principal and subtract the tax savings of only $1,821 every month, which is only 59% of the total PITI payment. So again, if we want to compare apples to apples, this would be as if, I'm doing air quotes, as if they're paying $1,821 per month in rent. So that at this point you ask them, well, what are you currently paying in rent? Let's just say they're paying $2,500 a month every month for rent. Rental appreciation here in California, it's closer to 5%, but let's just say we're keeping in line with inflation, is 2.5%, right? We can talk about some projections, but rent versus buy, they're paying $583 more to own a $500,000 house than if they were renting $2,500 a month. And they say, absolutely not, Jacob, that's unacceptable. So this is where we say, well, let's talk down the line, because the difference between the rich and the poor is a couple of factors, but one big one is longer term vision, right? Let's say 5 years down the line. Let's say 5 years down the line, what would this look like? 5 years down the line, if nothing happens, you just make your mortgage payment every month over 5 years, and every year there's 0% appreciation, meaning nothing happens in the marketplace. So that new value will be exactly the same as the old value. Just by making your mortgage payment, you will have paid off $54,000 plus of your mortgage, leaving you with a total new loan balance, because they put in $25,000, so you already had that amount of equity. Your new loan balance would be $420,000, leaving you new equity or total equity of nearly $80,000. After 5 years, if the market does nothing, just by paying down your loan balance every month, you would have $80,000 almost in equity. So if you subtract your down payment, aka your profit, you will have air quotes made, which is why I have profit in air quotes or in quotes, nearly $55,000. So that is one of the big differences with owning versus renting, is that forced savings plan. A portion, which is $850 a month, is going towards paying down that loan balance. And this amount increases every month, by the way. This is the lowest this number will be. Every month it gets a little higher, a little higher, a little higher, a little higher, because you're dropping your loan balance. Therefore, your interest will lessen, but your payment is fixed. Ergo, your monthly payment more goes to principal every month. So over those 5 years, you will have paid down this amount of money, leaving you with this amount because you subtracted your initial down payment. Let's say that the market appreciates in line with inflation. Let's say 2%. Let's see what changes to your equity and also your profit potential. If the market just stays in line with inflation, which, by the way, properties have appreciated about 10% year over year so far this year. Insane. Over the last, really, since 2012, they've gone up approximately 7% per year. So let's say it does significantly less than that over the next 5 years. So that $500,000 house is now $552,000. That leaves you with $131,000 in equity or $106,000 in profit. Air quotes. So at the end of 5 years, you have this to show for it versus what do you get at the end of 5 years of making your rent payment? Nothing, right? But also your rent has increased over those 5 years, 2.5%, and your new rental payment is $27.59 per month. But the argument is, well, Jacob, what if I would have saved that amount every month? Your total PITI payment would be this. Your total rent over the years would be that. That would be a difference of $27,346. But your tax savings alone by this number would have been $24,717. Again, check with your CPA, which even after, if you save all of this money and all you do is just offset it with the tax savings, you're barely ahead. But then subtracting your profit, air quotes, even if you save that amount every month, which you and I both know nobody will do, because we all, once we get a little extra jingle in our pockets, we find a way to let it leave. But if you did, you're still $100,000 in the hole or behind if you would have done this. Again, these are projections. Nobody knows what's going to happen in the next 5 years. But this is a great way to articulate the difference between owning and renting. And I like to do based upon just 0% appreciation. If all you do is pay down your loan balance, it's still a great option. Anyway, I hope this was helpful. I will save this for you guys. But there are tons of things that we can talk about for loans, one of which we actually didn't get into, which is the process itself, which this is already getting a super long video. So we'll do this on a subsequent one, or we can talk offline on that. But that's a great way to at least introduce us. I know this was a tall drink of water, but I hope that this gave us some idea on how we can at least know enough to further the conversation with our clients, to have a level of authority, but also to genuinely help them out. Because if we have this longer term vision and we give our clients the vision rather than at the end of the month, thinking end of the year, or even at the end of 5 years, if not a decade, these clients will be far better off in their lives if they treat this the right way. Of course, if they have job security, of course, if they know where they want to live, and if they are able to and they want to stay long term. If our job is not to convince somebody to buy, our job is to take somebody who's already convinced to buy, help them make the most informed decisions, and truly make a difference in people's lives for the better. If you have any questions, I'm here to help.